Hey guys. Hey guys. Ooh, we've got so many people online. Is everyone studying? got 71%. I got 2 wrong. Okay. CFA level 3. Oh, nice. Nice. How did you get through level 2? Teach us your ways, master. I can help you. For how much? Fixed income. Oh, I'm past the binomial tree. I didn't find it difficult. Yeah, I'm past the binomial tree. I don't think it was difficult. It was just new to me. Fixed income is actually my highest score. So I've got 71% average. And then I've got 60% on quants. And I've got 60% on ethics. But I've got 71 for fixed income. Thanks, man. Let me just check if it is really 60. I'm just quickly checking my performance tracker. Oh, 65. 65 for quant methods. Everyone else has 74. 70 for fixed income. Everyone else has 74. 65 for ethics. Everyone else has 75. So I'm like 10% under everyone else when I do that, compare with others on Kaplan Schweizer.
right, friends, welcome back. We are now ready to talk about analysis of credit risk. We are concerned about calculation of expected rate of return. Expected rate of return is simply an IRR type calculation, which is under an assumption that default will occur at the end of each of the years and seeing what would be the return under those hypothetical scenarios. The curriculum always restricts us to default occurring only at year end before the coupon is paid for, if there is a coupon payable on that bond. So there are two scenarios: there is no default, and if there is a default, when does it occur? Now we can use our financial calculator to do the calculations, and n is the number of period until default or maturity, as the case may be. Present value is the today's market price that will be given to us. The coupon dollar amount is the payment, and then now if the bond doesn't default, then the future value will be simply the par value. But if it does default, then it will be recovery minus coupon. The reason I'm subtracting coupon here is because I'm including coupon in the payment. This is just a specific thing that we need to recognize when we use the financial calculator, that whatever we put in the payment is supposed to occur at each payment date, or in this case, each year. And when default occurs, we only get the recovery amount, not an additional coupon. So to basically overcome the inclusion of that last coupon, because we are plugging it into the payment function of our calculator, I subtract it from the recovery. We'll also look at the calculation using the cash flow function on our financial calculator. All right, so what you are given, we are working through an example from the curriculum. There is a 3-year, 5% annual coupon, $100 par value bond. So the coupon is $5, n is equal to 3. And the bond is trading at a price of 104. Now you are given that the risk neutral probability, blah blah blah, is 1.5%. The recovery rate used in this calculation is 40%, and the government yield curve is flat at 2.5%. So based on these assumptions, we are first identifying whether the trader deems that the corporate bond to be overvalued or undervalued. So we are going to do the calculation for determining if the $104 price is fair or not. And then we will look at the expected rates of return, assuming that $104 investment. All right, first, doing the calculation for exposure. Now, this is a coupon bond. So earlier we had only looked at a zero coupon bond. So the exposure in year one is present value of the remaining cash flows. So what are the cash flows that are remaining after the first year? Well, there is a cash flow of $5. Remember, we are calculating exposure right before the coupon is paid. So $5 is already in present value terms. That is the coupon that is payable imminently. Plus, there is another $5 to be paid at the end of the second year. And then finally, the principal plus coupon of $5 payable at the end of year two. All right. Taking the present value, it is, so this part, I'm discounting 105. That is received at maturity for 2 periods at 2.5%. the $5 to be received at the end of second year is discounted for one period at 2.5%, and then the coupon to be received imminently is already in present value terms. I don't discount it. Well, same thing applies to year two exposure. Year two exposure, there will be an imminent $5 coupon plus the $105 to be received at the end of at maturity, and that 105 is 1 year away, so discounted for one period. And then finally, the 105 is the exposure. In year three, no calculation is exposure times 0.6 default. Is one. Minus 1.5%. And remember, you take 1.5. Here. So the risk neutral probabilities are 1.5% for the first year, and then remember you take 1.5% of the prior period probability of survival. So 0.985 times 1.5% gives you the second year probability of default, and similarly 0.985 squared times 1.5% gives you the third year probability of default. So the expected loss is equal to the loss given default times the probability of default. So multiplying those two items together gives you the expected loss for each of the periods. The discount factor based on 2.5% discount rate for each period. Simple calculation. Again, you're not going to be calculating the whole table for simply multiplication of expected loss times the discount factor. You add them together and you get CVA value, which is 2.722 in this instance. Now, so identical benchmark bond should trade at what price? Now remember, 3-year bond, the interest rate they're going to use, because it is a benchmark bond, the interest rate is 2.5%. The coupon rate is still 5, and present value calculation results in a valuation of 107.14. Now we subtract this CVA from it, and we get a value of 104.42. That is our valuation of this credit risky bond. However, the bond is trading in the market at 104. So comparing the two, we say that the price of 104 is low, so the bond is considered to be undervalued by 42 cents. Now we are going to look at that same bond and going to calculate expected return, assuming default at year 1, year 2, year 3, or no default. Let's do the calculation. So if default occurs in year 1, now the recovery amounts, and in year 0, 104, analysis, I find out the IRR 0.76%. And obviously, I want you to go through this calculation manually. Use this to do it with the cash flow factor, the CFC cash flow, and then calculate the I. Alternatively, I can say present value 81.492 I slash y. Now, if the default occurs in year 2, the recovery was 42.927. Six is the recovery amount, and your IRR comes out to be negative 33.27%. So the IRR turns out to be a lower negative return, and that is because it is actually annualized return. So if you hold for 2 years, you have 2 years worth of negative 33.27% return. Now, if I use the cash flow function, I will enter CF0 as negative 104, C0 757, or I can put present value is 104 and is equal to 2, payment is $5, and future value. Now I have to be careful. I'm going to be required to be subtracting $5 from my recovery amounts. is 37 point, I calculate, questions too. The cash flows are $5 in year one. That coupon was paid. There was no default at the end of year one. Second year also the company met its obligation, did not discipline coupon with the IRN, or you can plug it into your financial calculator and you get negative 22. .23 also. If I were to use the time value of money keys again, by now you should be A-okay. So 104 is the price we pay. Now we are looking at default in year three, so n is equal to 3. Payment is $5, and future value, once again, don't forget to reduce the recovery amount by the coupon amount, so 42 minus 5. Gives you 37, and then you calculate I/Y, and you will get par value plus coupon at maturity. So all we are going to do is the same. Standard time value of money, calculating yield to maturity, and that will give you 3.57%. And so that would be your expected return if there is no default. All right, relative credit and risk analysis. We have done this earlier where we compared the expected loss amongst different credit risky bond, and we said the higher expected loss means more credit risk. So that is all there is to it. Higher the expected loss, higher the credit risk. So you're given all the data. All I need to do is to focus on the last column, which is expected loss. And the bond with the highest expected loss is bond B. The bond with the second highest expected loss is bond C. And then finally, bond A is the lowest expected loss. So in terms of most risky, you start with B, then C, and then A being the least risky of these three bonds. So that is your ranking, B, C, and A. All right.
My study alarm just went off, but I'm already ahead of the curve. Okay, I haven't eaten. So I've got a quiz. Then I've got I think credit scores and credit rating. Let's do the quiz first. Got 100% on a quiz. I'm so tired.
Okay, friends, this module we're going to talk about the concepts of credit scores and credit ratings. Now, the LOS is just looking for explanation about what is credit scores and credit ratings, and we are mostly focusing on what happens to the return on the bond should there be a credit migration when a bond will move from one rating class to another rating class. So credit scoring and credit ratings are both called ordinal rankings, meaning they provide a ranking, a hierarchy, but the difference in credit quality between AA and AAA is not the same as the difference between AA and single A. So yeah, we know that AAA is considered to be safer, higher credit quality than AA bond, but the relative difference between the rating class is not the same. It is not a similar quantity. Same thing with credit score. We know that 750 credit score is better than 720, but the difference of 30 does not mean anything. It is not the same as difference between 690 and 720, which also has a 30-point difference. So they are ordinal, just provides ranking, higher score, better quality, higher rating, better quality, that's all. Now, credit scoring is used for small businesses and individuals. And credit ratings are used for
Place your bids.
corporate debt, ABS, and government as well as quasi-government bonds. Now, in the US, the FICO score relies on several factors, such as the age of the accounts, the age of the credit history, the number of delinquencies, the uses of line of credit, how much have you used, what percentage of total line that have you already used, the different types of accounts, the number of hard inquiries. So you checking your own credit report is not considered a hard inquiry. Companies that use your data by paying the credit reporting agencies, they also cannot claim those inquiries are also not hard inquiries. They are soft inquiries for marketing purposes. So that is basically there are 9 real factors behind it, and that makes up a person's FICO score. It is proprietary, so we don't have to worry about a formula or anything of that sort. Now, in the ratings, in bond rating classes, the same issuer, say for example, it is a corporation, may have different classes of debt or different series of bonds, and they may carry different ratings, even though the corporation is the same, the issuer is the same, and that is typically accounting for seniority. So more senior debt securities, those have seniority at the time of issuance will basically be commanding a higher rating as compared to junior securities, which come latter should there be a liquidation. And that is partly because of the loss given default. Junior securities will have higher loss given default. In addition to the letter grades of credit ratings agencies also provide an outlook, positive, negative, or stable. So kind of providing additional information to the analyst about potential changes in the rating going forward. All right. So let's look at a quick example. This is about a credit score. It is to some extent really not a fair question, but what you're given is Tess is a young finance professional who plans to eventually buy a 2-family house, live in one unit, rent out the other one. She's a careful money manager, diligent. Every year checks her FICO credit score. She's pleased to see that it has improved from 760 to 775 this year. Which of these factors can explain the improvement? And you're asked to select all that apply. So number 1 factor is she's now 1 year older and has not had any delinquencies on her credit file during that time. So basically, the length of history has increased by 1 year.
Yes.
That is a positive factor. So that is one factor. Now let's move on to the second one. Her bank on its own raised her limit on a credit card from 1,000 to 2,500, even though she has not used more credit. She has
That's
maintained
good
the same
because
average
your
monthly
utilization
balance.
is low.
So her utilization of credit granted to her has gone down. Percentage used has gone down. And again, the bank on its own, she has not asked the bank. If she had asked the bank, there would have been a hard credit inquiry. But the bank on its own has increased the limit, which results in lower utilization, which will benefit improvement in credit score. Number 3 is she applied for and received a new car loan from her credit union. So what has happened is, on the one hand, when you get a new loan, you are going to get a hard inquiry on your credit report. But it also we also recognize that she has used credit cards primarily, and now she is using a different type of loan product, a automobile loan, a monthly installment loan, and that will enhance her credit score. So that also is a positive factor. And then finally, the last one, she refrained from checking her FICO score monthly. Well, that is not going to go because she did not check.
It doesn't mean
improve her
anything.
score. So the last one is not a factor that could result in an improvement. So in other words, checking your FICO score does not degrade your score. All right. Now, this other LOS that we're going to talk about is the concept of expected return upon credit migration when the bond rating changes. So a change in rating will affect the value or price of the bond, and the change in price, nothing new. instead of, remember
I'm going to let you guys watch the auction. It's the last two cars that are what's naming now.
we use modified duration times change in yield. Here it is change in credit spread. So the benchmark is stagnant. We are keeping it stable, but the credit spread.
This is an interesting one. So it's a 2021 VW Polo. You'll see, like, you have to wait for the bid. You mustn't bid immediately. But the nice thing about this site is it shows you the asking bid and it has a bid calculator. So if you bid 52,000, it adds all of these amounts with the VAT, and then you see it increases to the total amount, which is the real amount that you need to pay. This is at Go Bid in the West Rand. So this is online. You see how many people are online. There's 116 people online. So that's the winning buyer, and then there's a countdown. If no one bids, then it goes to them at 54,000. Oh, someone else bid 53 and a half. Yeah, this auctions are quite tight. I mean, that's a lot of people that are online. It was sold for 54,000, 53 and a half. Then you've got a Polo Vivo starting at 17,000. So if you don't bid, then it's gonna come down. Thanks to me. I started at like 7ish. I'm actually gonna hop off and eat because I've eaten. So you see the asking bid comes down because there's no one bidding. That's what you want to do, but you don't want to do it multiple. You want to do it 2 times. The third time they remove the car. See, it was not sold. That was the last lot. Now it's finished.
Above the benchmark is changing. So end result is exactly the same. It is as if the whole yield has changed by that amount. So obviously the negative sign indicative of the fact that if the spread widens, if the delta spread is positive, then the change in price will be negative. So what you are given is, and this is a hypothetical example or an example from the curriculum, a double A bond that matures in 5 years has a coupon rate of 6%, modified duration of 4.2. This is an important piece of information we'll need.
Okay.
Now, if this bond's rating changes during the next year to A, so from AAA to A,
From AA to A. So credit spread 1 minus 4.75. 0.75% is the change, which implies delta P will be negative mod duration times change in spread. So minus 4.2, 0.75, 4.2 minus 2.15. So the answer would be C.
Use the from Triton and being it'll be 2% chance. and downgraded to single A is 8% chance, and so forth. We are not concerned about those probabilities. We are only concerned about the credit spread. So from double A to single A, the spread widens by 75 basis points.
Yeah.
So spread for double A is 1%. Now, because it is downgraded, the spread is wider by 75 basis points to 1.75%. So my change in price, and notice all 0.006, or you can just take, then that will give you a negative, which is corresponding to answer choice C. So that is how you calculate the price impact of credit migration. Basically, it is resulting from change in spread, and we are still using our standard duration formula to look for the change in price.
Oh, I'm so tired. Okay, there's going to be one quiz. Then there's something called structural and reduced form models. Yeah, let's do the quiz. Okay, it's 4 questions. Hopefully it's quick. Credit ratings incorporate A, default probabilities only, B, loss given default only, C, both the default probability and the loss given default. Credit ratings, I think default probabilities only. Okay, credit scores and credit ratings are ordinal, cardinal, or optimized. They're ordinal. And credit rating, the practice of notching accounts for differences in A, probability of default, B, business cycle impact, C, loss given default, A, probability of default. Then there's a question. Fixed income portfolio, beta bonds, currently rated A but with a negative outlook. Beta bonds have a modified duration of 9.2, so mod 9.2. Assuming that equal to the average, what is the average expected change if it downgraded from O to triple B? From A is equal to 0.49%, 0.60%, triple B 0.49 minus 0.6, 0.11. No, that is the spread. It implies percentage change in the price will be negative modified duration times change in spread. Yeah. Minus 1.12. I think A. Let's go, baby. Let's go. I got 50%. Credit ratings incorporate. I don't know, it incorporates loss given default. Hi. 50%. Hey. Hey. Oh, that's gonna kill me. Oh, I'm getting into options now. I think there's credit spread analysis. For how many of time? No. I need to be done with this. Then I can do CTS. Should finish this by Thursday. I don't know if I want to do derivatives after this. Because the shams is bulala. But if I can do fixed income and derivatives, flip. No, believe it. Yeah. Quant, ethics, fixed income. Then when I finish derivatives, I think after derivatives I'll need to do financial statement analysis. Otherwise that thing is gonna kill me. Let's see. Ooh, I'm finally on 25%. Ngulungulu, sis do that. I'm gonna get an early night. I need to eat and then I'm gonna sleep. Yeah, I wanna sleep at 10. So call it an early night, but I've been very productive. I'm on 25%. What I need to start thinking about is what happens after fixed income. So I have 58 out of 82 fixed income. That's 70% done. Yeah. So I'm not gonna do 100%. I'm gonna leave the exam and the topic quiz. So I'll probably do like 80, yeah, of the 82. And then it would make sense to do derivatives straight after a fixed income. But all of the women and me are also tired, so I'll see how I feel then. But yeah, it's either gonna be derivatives or maybe some financial statements analysis. But accounting is hard, and it's so much. But yeah, so I want to finish fixed income this week. So today's Monday, I've got Tuesday, I've got Wednesday, Thursday I'm going out. We're going to a cooking class, so it was a Valentine's Day gift. I'm really excited about that. It's so nice being spoiled. So Thursday I'm out, and then I've got Friday. But I've got other things I need to do, so I need to make sure that my fixed income is tight. And yeah, but the week needs to be productive. Work is busy as always. I'm sure you guys saw that oil touched $117 this morning. So that's a bit mad, but we're building here. Yeah, good night.